Okay, welcome everyone to our lecture on accounting for new ventures, liquidity and solvency ratios. We've got a few session objectives for the lecture two, which is firstly to understand key indicators relating to organizations. Financial indicators, ratios, they tell a story about an organization. Using horizontal or vertical analysis and using ratio analysis across three categories: profitability ratio analysis, liquidity ratio analysis, and solvency ratio analysis, we're able to tell really interesting, elegant, and thoughtful narratives or stories about organizations. And I'm going to help you do that in this lecture across multiple videos. So I'll help you construct these calculations and explanations of these indicators, and once we've learned how to structure up some of these ratios, we'll look at how we go about analyzing the actual performance, solvency, liquidity, profitability of these firms relative to the strategy they adopt. There really is no such thing as a higher ratio or a lower ratio in terms of performance. What we're really more interested in is, well, what numbers are ideal for what types of firms? So let's get cracking. Financial statement analysis, we say, is how we apply tools to analytical, mathematical tools to a company's financial statements. Its balance sheet, its profit and loss statement, its statement of cash flows. This is done with an intention to help us better understand the company's financials. You could call it financial health, as we do on these slides. You could call it position, its performance. But the idea is to better understand the company financially. To do it, we need the financial statements themselves, no surprise. We also need some sort of standard of comparison. You know, it might be internally generated. You might say, I want this number or this ratio or this level of performance. Or it may be an industry target. It may be, well, we want to be the number one in our industry. And who's number one? Well, let's see if we can mimic their numbers this year. And so they might form the basis of our targets. Or you may have industry targets, which are broader industry averages. If you're a weaker company, perhaps below the industry average, you may aspire for an industry average, or to do better than the industry average. So there are different ways to set standards that you might want to attain. We can then go ahead and analyze our ratios in multiple ways. Now, there's a million different ways to analyze these ratios. I've put up here DuPont analysis as a simple way to take a ratio like return on equity and deconstruct it into its component ratios, and to then tell very interesting stories about companies using that deconstruction. Now, just so you know, for this lecture and the next lecture on profitability ratios, lecture 3, I'll be using financial information provided by Myers Financial Statements. We all know who Meyer is in Australia, and I've attached the relevant My Annual Report. You've got the attachment through Slack, and it's of course attached as a separate file to this PowerPoint file on MBAE Slack. I do encourage you to keep that annual report next to you. Refer to where the numbers might come from. The majority of the numbers come from the 3 financial statements, but some come from the notes as well. And I encourage you to be a bit bold and go out and look for those numbers in the notes, in the attached annual report I've passed on to you by PDF in Slack. We'll also, of course, revisit horizontal and vertical analysis, which we touched on in lecture 1, but we'll do them in a little more detail in lecture 2. So, go back to standards. You know, when conducting financial analysis, there should be some benchmarks for us to reflect on how healthy our number is, for us to compare. The most common benchmark is probably an intra-company comparison, where you might use last year's numbers as a benchmark for this year's numbers. You know, at a minimum, you want this year's numbers to be better than last year's numbers, so perhaps you might use last year's numbers as a benchmark. If you're doing this, you're probably going to be very suited to the idea of horizontal analysis. Another common benchmark is an intercompany comparison, where you might want to know, what is my gross profit percentage versus my competitor? What is my profit margin versus my competitor? Now, if you're talking like that, what you're really asking yourselves is, the ability for you to do a vertical analysis. And I'll talk you through what a vertical analysis is. So horizontal analysis, you're comparing previous period numbers to your numbers this period. Vertical analysis is when you're reflecting on the relationship between numbers in your, say, organization versus other organizations. You can do both simultaneously, but I'll get to that later. A final benchmark, of course, is industry standards, and we've talked about that. So the three most common analytical tools, and you'll probably have gleaned this from the start of my lecture, from the recording today, is horizontal analysis, vertical analysis, and finally, ratio analysis. Now, we'll touch on horizontal and vertical analysis, but for the majority of Lecture 2 and the entirety of Lecture 3, we'll be doing ratio analysis. Let's now think about horizontal analysis. Horizontal analysis is a technique that basically calculates the change in an account balance from one period to the next. It then expresses that change in both dollar terms and percentage terms. It's a very simple tool, but I can tell you from sitting on boards of medium to large organizations that it is a tool that the board loves. Senior management love doing simple techniques like these to give them a sense of how effectively, to give them a sense of how well they're going this year relative to last year. The maths is really simple, but its utility far surpasses the simplicity of the method, and is perhaps helpful because it's that simple. Let's consider the financials of the Myer Group. Now, Myer is Australia's largest departmental store group. We know this. It's got a sales turnover of approximately 1.6 billion, I should say 3.2 billion Australian dollars, 1.6 billion pounds, and it employs 12,500 staff. Let's start with some horizontal vertical analysis as a revision and then move on to our ratio analysis. So, Myer's income statement. Here's an example of horizontal analysis. The figures are in millions, guys. You might note just from this table here. In 2013, cash and cash equivalents were $81 million. In 2014, they're $74 million. That change of $7 million represents an 8.64% reduction in cash holdings from 2013 to 14, 81 down to 74, a drop of 8.64%. How do we get 8.64%? Well, our base year is the first year, 2013, the earlier year. We subtract the change by the base year and divide that difference by the base year value to get the percentage. So 74 is the more recent figure, 81 is the base year figure. That change of minus 7 divided by 81, the base year, is a drop of 8.64%. That basically is horizontal analysis. So you can see 74 less 81 is our minus 7. Divide that by 81, the base year, and we get a drop of 8.64%. Let's now think about perhaps sales revenue and cost of goods sold. In Myer, you can see that sales revenue marginally decreased from 2013, $3.145 billion, to 2014, $3.143 billion. It was just a $2 million drop, but it was a drop. Now that drop of $2 million divided by the base year value of $3.145 billion is a drop of 0.06%. A very small drop, but nevertheless a drop. Cost of goods sold, however, increased. It increased slightly, but it did increase. It increased by $12 million from 1.443 billion to 1.455 billion. That increase of $12 million represents an increase of 0.83%. $12 million divided by the base year 1.443 billion. So 12 divided by 1,443 million, which is 1.443 billion, is 0.83%. So in a year where our sales dropped, our cost of goods sold went up. Now, that might cause you to ask questions. You might go, well, why did sales drop and cost of goods sold go up? Normally when you sell less, the cost of what you sell should also drop. But cost of goods sold appears to have gone up. Why is that? And we can investigate that issue further. The numbers hint at issues for you to pursue. We'll now touch on vertical analysis. Vertical analysis is really a technique where you compare a single account item in the balance sheet or in the income statement by a summary or foundational number in the balance sheet or income statement. Now, typically, when we do vertical analysis, and in accounting for new ventures, this will be our assumption. When you do vertical analysis for the balance sheet, you take any account in the balance sheet, asset, liability, or owner's equity, and you divide it by total assets. Why total assets? Because total assets is the single largest number in the balance sheet. Remember the accounting equation? Assets equals liabilities plus owner's equity. Well, if assets equals liabilities plus owner's equity, then all of liabilities and all of equity must add to give you all of assets, total assets. It's that single largest number in the balance sheet. So any number divided by total assets should give you a number, a percentage between 0 and 100, because no number in the balance sheet will be larger than total assets. For the income statement, you've probably guessed it, for any normal profit-making company, and indeed even for loss-making companies, the largest item in your income statement will be sales revenue. Why? Because, well, if you've made a profit, you've got to have enough revenue to cover all your expenses. So clearly, revenue is going to be bigger than all your expenses, and certainly bigger than each individual expense. If you've made a loss, revenue, okay, all the expenses put together are greater than revenue, but it's highly unlikely that revenue itself will be smaller than any individual expense. And so we say that revenue remains the best number to use as the denominator, the base, for vertical analysis in the income statement, the profit and loss statement, the income statement. Now, let's look at how this might manifest. Now, why might you do vertical analysis? Well, you might be interested in how your revenues are used up by your expenses before they become profits. If you care about that, vertical analysis is perfect. You might care about how assets are composed in your balance sheet. You might care about liabilities and owner's equity as a percentage of your assets, where the money is coming from, debt and equity, who's supplying the funds, and how it's being invested, assets. And so you can answer these quite nice questions using vertical analysis. Another benefit of vertical analysis, which was in the prior slide, is just this point at the bottom here, that vertical analysis allows us to compare between different companies irrespective of scale. So you can, technically, if you really wanted to, you probably wouldn't, but if you wanted to, you could compare, say, McDonald's to the corner shop that flips burgers. Yes, they may be vastly different in size, but hey, what is their gross profit as a percentage of revenues? What is their net profit as a percentage of revenues? You can learn about their relative profitabilities, their relative financial health by thinking vertical analysis, by applying vertical analysis, because however large the numbers or small the numbers, the percentages are the percentages, and they standardize the numbers so you control for size, and that can be a benefit of vertical analysis. So let's now think about the vertical analysis logic. If you have a company that, for the balance sheet, is interested in how its total assets are deployed, well, you want to know first where the money comes from. It comes from debt, comes from owners' funds. That's how we use money. We get money from there and we use it to deploy assets. Total assets is that single largest number in the balance sheet. Total sales revenue is the single largest number in the P&L. And that's why we use total assets for vertical analysis in the balance sheet and total sales revenue as the vertical analysis denominator for the income statement. I know I said that before, but I really want to emphasize that. So let's look at how we might crunch these numbers. In 2014, we know that Myers cash dropped from 81 million to 74 million from 2013 to 14. We also know that from our Meyer financial report in the balance sheet, we know that Myers 2013 total assets is 1.940 billion. 2014 it was 1.933 billion. Myers total assets value dropped just that little bit. Now, in 2013, what is Myers cash as a percentage of its total assets? Well, Myers cash, 81, divided by 1940, is 4.175% in 2013. In 2014, Myers cash is 74 divided by 1933. It's 3.82%. Now, that tells me that Myers cash holdings relative to its size has declined. So why is Myer holding less cash as a percentage of its total assets than it did last year? It could just be a function of its reduction in sales. It could be that the company is managing cash better and investing any excess cash it has. It could be that the company isn't doing as well and so is kind of struggling a little bit, and so its cash reserves have, its cash holdings have dropped a little. These are all interpretations, they're stories. Ratio analysis won't tell you the final story. It'll give you possible stories. You, as the entrepreneur or the accountant with that skill set, you go around investigating, finding out the real reason. But financial ratios will give you the possibilities to pursue, so it directs you. You then talk to key individuals in the firm or key managers or partners, and you find out, why is it that I'm holding slightly less cash relative to total assets this year than last year? And if the reasons are fine, they're fine. There's nothing to worry about. If the reasons are not, well, then you might want to engage in corrective action. Let's think about Myers cost of goods sold. We think about the income statement. We just looked at a balance sheet example. Let's now think about an income statement example. Myers cost of goods sold was $1.443 billion in 2013, and Myers sales revenue was $3.145 billion in 2013. 1.443 billion divided by 3.145 billion is 45.88%. 1443 billion divided by 3145 billion is 45.88%. In 2014, cost of goods sold divided by sales was 46.29%. The cost of goods sold percentage has increased ever so slightly from being 45% of revenues to 46% of revenues. Now, managers might go, look, that's concerning, but it's not material, we're not going to lose sleep over it. Or managers might go, what? Why has cost of goods sold gone up as a percentage of revenues? Is it because of the nature of the products we're trying to sell? Are we perhaps not selling as many high margin products? We're selling lower margin products. So even though sales have dropped, cost of goods sold percentages have gone up. What is the reason for this result? And that's where I think vertical analysis really helps you identify problem areas or issues for you to delve into in firms and try to organize, whether it's your own entrepreneurial firm or whether you go back from this MBA entrepreneurship and go into a large firm and do R&D in that firm. It helps you understand these specific relationships between numbers and to therefore try to extrapolate narratives or stories from those numbers.